So today we're talking about the future of the economy, the future of the stock market, and the future of playing cards. Just kidding. The government likes to call them fun coupons. The future of our money. Now, I've been a long-time dividend investor with Robinhood, but in the last 3 months, I've been down quite a lot of money. So in the last 3 months, I've been down about $47,000, which is a lot of money to me, considering I don't have that much to begin with, relatively speaking. Some people make this much per month. The cool thing about dividend investing and the way that I like to invest is that I focus on cash flow from stocks that have dividends. So regardless of what these stock prices are actually worth, I still get paid every single month, every quarter, every year. I still get consistent paychecks that pay me to survive and do nothing, which is extremely important, especially right now when millions of Americans are still waiting for their stimulus checks to come in so that they can use that money to pay for food. Dividend investing is amazing. The stock market lately has been this crazy thing, and today I wanted to really make sense of what's going on and finally answer the question, should we start investing now? Should we continue investing, or should we wait for another spectacular stock market crash? The reality is, I'm not smart enough to answer that question on my own. But the good news is that I know someone who might be able to, and I'm so excited to have him on, so let's begin. Hi everyone, my name is Andrei Jikh, and today I had the incredible opportunity to speak with legendary investor Raoul Pal. He's one of the most well-respected people in the finance space. He was a former hedge fund manager for Goldman Sachs and one of the smartest people alive today in the finance space, with a focus on macroeconomics, which is a fancy word for saying the study of how macaroni impacts economics. No, I'm kidding. That's not at all what it means. What it means is looking at the overall trends of the economy to try to get the big picture of where we're going in the future in an effort to try to make money with that. So just a few days ago, I put out a poll on my Instagram page asking you to let me know which questions I should ask Raoul. And I combined all of your questions into a narrative that I felt we could all use in order to understand what exactly is happening in the world right now. How do we make sense of all of this madness? And on top of that, how can we use this information to look into the future in order to predict perhaps what might happen and how we can use our money to capitalize on that information. So without further ado, let's not beat around the bush, let's start the video and let's ask Raoul the first question, the doom loop. Can you please help explain what the doom loop is? What is this major issue of corporate debt bubble and how the insolvency might follow? What does this mean? I know some of those words.
It's a little bit complicated, right? But what it means is, as opposed to the audience who's watching this, there's actually a huge group of people called the baby boomers. And the baby boomers are aged around 66 years old on average. And they've got this huge amount of money in their pension pot and they're about to retire. So if you think about people retiring, what do? They spend their pension. That's the point of having a pension, to get income once you've stopped working. Now, all of that money is invested basically in two things, the stock market and the credit market. So the credit market is where companies borrow money by issuing bonds, and your pension buys them because they get a return on it, a yield. So that's all well and good until the business cycle goes down. Once the economy starts slowing down, it sets off something called the doom loop. And the issue is that the only buyer of stock markets really over the last 5 years has been the corporations buying back their own shares, because all the baby boomers who have all the money have been trying to sell shares over time as they get older. And the millennials haven't bought as many shares. They've bought some index funds, which has screwed up the market a little bit as well. That's a different thing.
So we're setting the stage right now. Baby boomers are leaving our economy. They are ready to retire. Millennials, on the other hand, are not buying that many stocks of companies because we broke. Meanwhile, the people that are ready to retire right now are selling off their stocks to fund their retirement, which makes sense, right? But corporations, on the other hand, are no longer issuing debt to fund share buybacks, which means their stock prices can no longer grow at the same rate as they once were. So on the whole, nobody is buying stocks right now. I mean, sure, I'm buying stocks, you're buying stocks, perhaps people you know, but we are just a small part of the people who actually buy the stock market. So with that said, what can we expect going forward?
So what happens is in a recession, all of these companies don't have enough cash to pay debts. So they stop buying back their shares because they issue debt to buy shares back. So then suddenly the buyer of equities has left the building. On the other side of the equation is those bonds. Those buyers were the pension plans, like Illinois and Ohio and Connecticut, whatever. Now, all of those guys don't have enough money for the promises that they made to these baby boomer retirees. So they've been using tax receipts to prop up their pensions. And what happens is in a recession, obviously nobody pays taxes. So then there's no buyer of bonds either. So you get a situation where companies have borrowed an extraordinary amount of money, the most in history, and everybody's pension is invested in this stuff. And now suddenly there's no buyer of equities and no buyer of the corporate credit, which is why the Fed had to come in and buy some of this credit to stop the entire pension system blowing up.
That's when the Federal Reserve steps in and... But instead, what we got is a government that's largely made up of all of these older people that are doing their utmost best to prop up this market by printing more money and buying up all of this corporate debt, therefore not allowing the whole system and the stock market to correct and go down like perhaps it should. So that makes sense. My next question is, do you think that we'll see less of a return in the stock market in the near future?
Well, here's a group of people with all the assets. Here's a group of people with no assets. What the free market should do is allow those prices to adjust so these guys can buy equities at cheap valuations so they have an expected future return that's high, or be able to buy property, whatever it may be. The problem is the millennial generation is stuck with all-time record valuations in equity markets, zero interest rates to make money from bonds, property at all-time highs. So what is the opportunity set? And the government, in the meantime, doesn't want to allow these baby boomer voters of 76 million, who all of the government are made of, they don't want them to go bust. So they will support these guys at all costs.
So why is this happening? That's one of the questions I had for Raoul, and maybe the obvious answer is because the illness, and it's never a good idea to shut down the economy for such a long period of time. But what's less obvious is asking, why are so many people saying that it's going to get so much worse? And we're gonna look back at this in hindsight, and it's gonna be obvious, but where did we go wrong? Why are they doing this? Why don't they allow the free market to work the way it's meant to work?
Along the road from let's say 1980 to now, we created a huge problem, which was allowing debt to grow. As interest rates fell because of this aging population and their investment in the bond market and how that drives interest rates lower over time, debt rose massively because people thought, oh, debt's cheap, I'll just take more of it. So the problem is if you allow that correction, you're going to blow up all of the debt, which is an insolvency crisis when companies can't afford to service their debts and they go bust, unemployment rises and all of that kind of stuff, and the pension plans blow up as well. So there's the real fear of what it does not only to the baby boomers but to the entire financial markets and the global economy because of consumption. And guess who loses their job? It's the millennials who lose their job because the others have been retired. It's a screwed up situation. And this is why so many younger people are angry or opting out of the system. I mean, it's extraordinary that the rise of TikTok tells you one thing, is people just want escapism because the reality is not good.
No one cares about what millennials have to say. That's what we were taught. The lazy me generation. They deserve it, those avocado-eating, lazy Starbucks-sipping, coffee latte, good-for-nothing millennials. Now, I'm not blaming anybody here, but the sad reality is that millennials are not exactly inheriting a bright financial future ahead of them. And because of that, instead, we were given a social media medium in which to occupy our sanity with. It's the market's answer to a generation that wanted to perform for itself. So the market said, here, perform everything to each other all the time for no reason. It's performer and audience melded together. Because what more do we want than to lie in our bed at the end of the day as a satisfied audience member of the sad reality that we inherited? Boom! Bo Burnham snuck in again. So what should we do with our money then? Solve all my problems for me, Raoul. What alternative do we have then besides the stock market? That's all we've ever been told is real estate, bonds, stock market mainly. Where else do we go?
Crypto.
Crypto, that was kind of going towards that direction.
Well, listen, I may be wrong, but let's say you're a 26-year-old, right? And you think, you've got $5,000 of savings and you think, well, what's the point of buying stock market all-time highs? I don't know what I'm doing. I'm going to lose money. But Bitcoin, for example, is a potential asset. And if anybody ever wants to know more about it, read Safedine Amos's book, The Bitcoin Standard, which gives you a really great understanding about why Bitcoin is a really great asset for savings. Now, the good thing about Bitcoin is its expected future return is very high. Could it go to zero? Probably not anymore. Could it fall 50, 60% from here? Of course. But its expected return is maybe 100 times from here. So you actually have an opportunity as a young person that even if it goes wrong and it doesn't work out, and you wipe out half of your $5,000, you've got plenty of time to make it back.
Raoul's answer to this question is a hedge or a bet against the current system. And it's great because it has something called asymmetric risk, which is a way of saying that the upside is 100 times greater than its downside. And the reason why it's great is because it almost makes zero sense not to have some of your money in some of this asset. Because if it fails and maybe goes to zero, well, then you've lost a couple $1,000s. But if it succeeds, then it'll be worth everything. And we're not talking about Bitcoin being worth $20,000 or $100,000. We are talking about big picture where each Bitcoin can be worth millions and millions of dollars. And as for me, I would like to have a small piece of that financial future. But maybe you're not entirely sold on the idea of Bitcoin at all, and that's totally understandable because the time horizon for Bitcoin requires a lot longer. So if you're gonna retire sooner, then Bitcoin may not be the best investment for you, and maybe you should try gold instead. But I wanted to ask Raoul, what if I'm an index fund investor? Or what if I'm a dividend investor? Or what if I'm a real estate investor? What should I do in that case?
Right now, it's a very complicated situation, but you may be given an opportunity to buy things very cheaply. An old adage that somebody told me when I was 22 years old that I've carried for the rest of my life, which was, he who has cash in a recession is king. The price of stocks fall, the price of real estate falls, the price of goods fall. You can buy anything in a recession for less. So the idea is, where do you start investing? Do you start investing at all-time highs and record valuations? Or do you just sit on cash and say, cash gives me the chance to buy shares if they fall 50% or more? So then your future expected returns go up. And a bit of crypto, that makes sense too. Now, real estate is an asset because you live in it. And I always advise people, if you can, buy a house and try and pay it off as fast as you can. Because then if anything goes wrong in your life, you've got a place to live and you can basically get a bar job and cover your costs. But that means paying off a house. But if you can do that first, then you've got the strongest strength possible from which to operate. But that takes time to do and a bit of luck and a good career.
What should we be avoiding in the market right now? Besides not panicking, besides not selling everything we have, besides not playing Final Fantasy VII and letting it consume every single second of your breathing day because there's more to life than that, what should we be avoiding right now?
Don't blindly listen to Wall Street. Wall Street, their job is to get your money out of your pocket into their pocket. So even with index funds, they're telling you a narrative is stock markets always go up. So this is a no-brainer. That's a false narrative. If you look at the Japanese stock market, the third largest economy in the world, that stock market peaked in 1990 and it went down 70% and has basically been trading sideways in a big range over 30 years. Wow. Now, Europe peaked in 2000 and it's been doing the same. So don't, Taiwan, South Korea, many of these markets peaked or have been around the same levels for decades. If you look at the UK equity market from 1750 to 1950, it traded sideways because stocks should go up and down basically by the business cycle and the earnings. But it's this massive drive into pensions that created this valuations bubble that we've had today.
Okay, so is the market going to go up or is it going to go down?
My personal bet is that over time, over the next 3 years, because of the situation we're facing, which is the biggest economic crisis the world has ever seen, the chances are that reality catches up with the stock market as the baby boomers are forced to sell to retire. So I think the market goes down significantly over time and then probably trades sideways for 10, 20 years and doesn't go up, in which case the kind of strategy that you're talking about of dividend shares, you're looking at it in a different way. You're looking at accessing the cash flow from the corporations, and it's less driven by capital gains and more driven by income. That makes much more sense in that environment, and that will work well over time.
Well, that feels good to know that being a dividend investor actually makes sense in a market like this. And as for me, I'm going to continue to be a long-time dividend investor, and I'm going to continue to put money into the stock market regardless of what it's doing. So I think now is the time when dividend growth strategies are really going to shine in an era where you may not see a ton of appreciation in the form of stock price growth. You have to collect those paychecks instead. And if you are interested in watching more of Raoul, you can find him on his YouTube channel. You can also go to realvision.com. That is his website. I will leave all these links in the description below the video. But in the meantime, go sign up with Webull, fund your account $100, get 2 free stocks, one of which could be valued up to $1,400. Go sign up with Robinhood, get your other free stock. There's your free money. Enjoy the rest of your weekend. Love you. I'll see you on Monday and Friday. Follow me on Instagram. And I think there is a silver lining to all of this. We will get through this if we're smart with our money. See you very soon. Bye-bye.